Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.isc.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
As you can see, back in the late 80s to mid 90s, we traded very closely off of this key support level that we've identified here. We then rallied, or the U.S. dollar then rallied. Now again, this is a look at the U.S. dollar against most or a basket of major currencies. So it's basically taking your yen, your euro, your Canadian dollar, and what have you, and just saying, okay, how is the U.S. dollar performing against all of these? So in the bigger picture, we had a big rally into this particular resistance level. We've since had that significant downtrend that I referenced last week in our weekly outlook, just to kind of give people a little bit of an idea. And as you can see, that low came in very strategically along this key support level that we've identified in here. So with that in mind, what we can now do is we can step back and say, okay, well, where is a next logical target for this, albeit not necessarily in a straight line, but over the bigger picture, where's the next logical target? Well, we can kind of condense this look to the shorter time frame, and we could say, okay, well, we seem to have a little bit of a bottom support line playing in here. And in keeping that in mind and drawing our 50% lines here, you could see that everything sort of culminates in this 90 to 95 focal zone. So and again, there's a number of other different tools that we would use, but this key area here appears to be a very logical area of resistance over the shorter time frame, or a very logical target for our U.S. dollar to trade up into. And we can't expect this to happen in a straight line, but what we can do is we can use this information to then set up potential trade opportunities on a smaller time frame with our FX options pair values that we've been discussing. So bigger picture trends represent opportunities for us to take advantage on the smaller time frame. Now, if we actually look down at our MACD, and for those of you that understand MACD, your MACD is essentially measuring your strength and trend. So as you can see here, hopefully you can see my arrow. When we started this major U.S. decline in value, our MACD crossed over and continued in that direction. We had a little bit of a hiccup. We had a nice little bit of a push up, and we've since seen our MACD in a decline. We've now, in the bigger picture, again, this is a monthly chart, have crossed back up again. We've also seen these lows. Maybe if I can draw this in and you might be able to see this a little more effectively. We see these lows from here to here. I apologize for that not being a straight line. Kind of going against what we see here as far as our MACD. So that's showing that what we refer to as convergence, meaning that we played into these lows, but there's less strength in that trend. There's less commitment to those lower lows. So those are also signals suggesting we're looking for a little bit of a rally. So with all that in mind, we can then move forward and say, well, how do we take advantage of this? Well, if we look at our CDD, which is our U.S. versus our Canadian dollar, you can see that we've had a significant rally back from essentially when we were trading at par, which is not actually indicated in this chart here, but when the U.S. dollar was trading against the Canadian dollar at par, we've had a very significant rally over the last little while. And that being said, or with that in mind, Steve had mentioned the whole concept of options volatility and the fact that the volatility on the CDD has increased significantly since, several months ago. We were trading if I had a bigger picture here, we were trading almost sideways for a certain period of time. And when a market is trading in that type of pattern, you generally see your volatility relatively low, because what happens is that there's really not a lot of historic volatility. The market's not anticipating a big move, but as you start trading higher, and in this case higher and higher, the anticipation builds and your option premiums increase to reflect that. Now, what we looked at last week was this 119 to 121 level, and we in fact suggested that the Canadian versus the U.S. versus the Canadian dollar, this pair value would likely kind of have to make a decision at this point, because it was an area that we recognized over the bigger picture as being a key level of resistance. And you can see that as we pulled off of that and traded into that level. Notice the rejection here. Notice the rejection here, and the rejection here, or the inability to push to higher highs. We suggested that if we broke out of this level, we'd likely push into this 124 to 125 range. And again, you could see that we did indeed do that Wednesday, Thursday, Friday. We pushed into that, we pulled back, and then broke out. Now, this break above this key level that we've identified here now opens up the window, coupled with the continuation in our strong trend to the upside and our continued momentum to the upside, to play up into this 130 to 133 zone. So all we're doing is we're more or less breaking down this price action based on probable areas of support and resistance. And since our momentum seems to be carrying us through these ceilings, if you will, we recognize that the next logical target is going to be the ceiling above the higher floor, if you will. So if you think about these in the context of being floors and ceilings, okay, we find support at the floor, and generally as we push off that floor, the next logical area or target is going to be up into this 130 to 133 zone. So to kind of reference what Steve was mentioning with respect to options being expensive and the idea of using spreads, we can use these key targets as areas for placing our or selling our options as our short leg of the spread. So, for example, if we anticipated a break out of this level here, trading up into the 133, or so on, what we could do is we could buy down here, pay our expensive premiums based on volatility, but then offset some of that cost by selling our options up here, recognizing that over the shorter time frame, okay, we're likely to trade and meet with some resistance in that area. Now, there's a strategy that I'll talk about towards the end of the presentation here that you can actually use to help take that longer-term view, if indeed that's what you subscribe to, with respect to that strengthening of the U.S. dollar, but at the same time help offset the cost on a month-to-month basis. And you could do that using a strategy referred to as a calendar spread. So it's the same type of approach where you're buying a key level, looking for the U.S. dollar to appreciate, but every month you're selling that volatility, collecting a premium, and offsetting your risk exposure and the cost of your expensive option. Okay, so your CDD, again, most likely, based on what we're seeing here, will play into this 130 to 133 focal zone. At that point, we have to look at the possibility of the market turning around and conceivably retesting either into this level here, or if that doesn't hold, back into this next support level and at the 119. We always have to keep an open mind. We have to understand that, again, there's a number of factors at play right now from an economical perspective. Of course, the interest rates of all of these different pairs that we're looking at against the U.S. dollar are going to have an influence. Mr. Bernanke is speaking tomorrow. Of course, if he lowers interest rates, then what's going to happen is, of course, we may see a weakening of the U.S. dollar. That is not to say that the bigger picture outlook is now wrong. What it means is that we have to change our short-term objectives to fit what the story is or what the technicals are suggesting to us. So if we don't break into those key levels that we were suggesting, sorry guys, I'm just going to go back. If we don't hold if we don't break into these key levels here and trade up at the 130, recognize that if we break back into this 124, the next logical area of support is down here at the 119.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.